Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about AXON Enterprise Inc. quarterly report. AXON Enterprise Inc. offers a wide range of products and services across various industries. The company's product portfolio includes conducted energy devices, CEDS, under the Taser brand hardware solutions such as cameras, e.g. AXON Body, AXON Flex, cloud-based software solutions for digital evidence management, e.g. AXON Records, Evidence, mobile applications training services, hardware extended warranties accessories, e.g. AXON docks, cartridges, batteries. The company also provides various services including software subscriptions, e.g. auto-transcribe, justice, data analysis, and sharing capabilities through its partnership with Fusus, Inc. Secure storage and management of digital evidence. AXON Enterprise serves a diverse range of industries, including law enforcement, federal agencies, healthcare, retail, private security, and personal safety. AXON Enterprise, Inc.'s stock price has increased by 34.59% over the past year due to strong financial performance and optimistic outlooks. A key event was its Q2 2025 earnings report, which saw a 16% surge in stock price on the same day. The company's revenue grew 33% year-over-year to $668.5 million, exceeding analyst expectations. AXON raised its full-year revenue outlook, driven by demand for digital evidence management and Taser devices. Strong Q3 2025 earnings, with 31% revenue growth, further boosted investor confidence despite a mixed market reaction. The company's strategic focus on AI and emergency response solutions has contributed to investor enthusiasm, leading to the significant increase in its stock price. The primary drivers of revenue growth or decline can be summarized into two main categories: positive and negative factors. Revenue growth is primarily driven by an increase in contract assets, accounts and notes receivable, and revenue from short-term investments. Additionally, the connected devices segment experienced significant growth, while the software and services segment also saw a notable increase. The company's ability to deploy SaaS solutions efficiently and its scalable IT infrastructure have also contributed to revenue growth. On the other hand, revenue decline is primarily driven by negative publicity, reputation damage, and defects or disruptions in services. Loss of customer trust due to service unreliability has also been a significant factor. Regulatory requirements and compliance costs, data breaches, and disruptions in cloud services have further contributed to revenue decline. Net income and profit margins. A year of decline, the financial performance of a company has seen significant fluctuations over the past year. Net income decreased by 49.6% from $241,850 million in YTD 2024 to $121,911 million in YTD 2025. This decline is also evident in the third quarter of 2024 and 2025, where net income dropped by $69.2 million. Profit margins have also taken a hit. Gross margin decreased from 60.7% in Q3 2024 to 60.2% in Q3 2025, while operating margin plummeted from 4.4% to -0.3%. The gross margin for the entire year also saw a decline from 64.3% in 2024 to 63% in 2025. The decrease in net income and profit margins can be attributed to various factors, including changes in market conditions, operational inefficiencies, or strategic decisions made by the company's leadership. However, the exact reasons behind these declines are not explicitly stated in the provided summaries. The company is indeed generating positive operating cash flow, as evident from its financial summary. A closer look at the numbers on page 16 confirms this trend. The total operating cash flow, OCF, stands at a substantial $1,015.5 million. This figure is calculated by adding net income $878.7 million, depreciation and amortization $322.9 million, and other operating activities $14.3 million, while subtracting the change in working capital minus $198.4 million. The positive OCF indicates that the company's operations are generating sufficient cash to cover its expenses, making it a financially healthy entity. The company's debt level and interest expenses have undergone significant changes. Initially, total liabilities increased by $1,482,692 from 2023 to 2024, page 3. However, after exchange transactions, the debt level decreased to $282.5 million, page 24. Later, it increased again to a total aggregate principal amount of $300 million, page 39. Regarding interest expenses, there are conflicting reports across different pages. Nevertheless, the overall trend indicates an increase in interest expenses. For instance, interest expenses rose from $1,725 in 2024 to $56,468 in 2025, page 7, and also increased significantly on page 48, $28.9 million versus $1.6 million. The company's financial performance reveals several areas of underperformance. International markets, countries with limited operating experience, those with restrictions on foreign ownership and investments, and nations with stringent foreign exchange controls all struggled to meet expectations. These challenges hindered the company's overall growth and profitability. Management is optimistic about the company's growth prospects, expecting further expansion in sales and revenue due to investments in research and development. The long-term strategy remains focused on growth through innovation and expansion into new markets. To achieve this, the company will invest in non-public technology-driven companies, acquire additional equity interests, and expand its product ecosystem. Management acknowledges potential challenges, including strain management, operational, and financial resources from rapid growth. They also caution that past performance may not be a reliable indicator of future results due to various risks such as changes in tax rates and liabilities, revenue fluctuations, and intellectual property infringement. To mitigate these risks, the company plans to offset price inflation through increased prices for customers with long-term contracts and expand production capacity to meet increasing demand. Overall, management is committed to driving growth while navigating potential challenges and risks. And there are concerns about inventory buildup and potential supply chain disruptions. Inventory levels have reached a critical point, with multiple references to the issue throughout the report. Similarly, there is a risk of supply chain disruptions, which could further exacerbate the problem of inventory buildup. These issues warrant close attention to mitigate their impact on the business. That concludes the financial summary for AXON Enterprise Inc. Feel free to comment below, and I will be happy to answer them when possible.